In the latest flow show report issued by Bank of America's chief investment strategist, Michael Hartnett, he mentioned some very interesting points regarding when is the tech bubble, the Magnificent Seven bubble, going to pop. According to his report, the investors are capitulating into AI leaders, meaning that there's a lot of FOMO going on. People are chasing into buying those stocks, especially the Magnificent Seven stocks. These stocks have a trailing PE ratio of 62 times, which exceeds the valuation seen in previous historical bubbles. And the equity market breadth is very weak. And according to this chart, as you can see, only 31% of S&P 500 companies are actually outperforming the S&P 500 index. And this is 2024. And it's actually at a level similar to the 1998, 1999 tech bubble or dot-com bubble era. But Michael Hartnett said historically central banks, like the Federal Reserve, are the ones that end these melt-ups, okay, or aka the bubbles. By doing what? It does it by raising interest rate or tightening monetary policies to control overheating markets. Okay, and this table provided by Bank of America, Michael Hartnett, shows some of the examples of the bubbles ended by central banks. As we can see, Magnificent Seven is over here, which is our current bubble or melt up. It's currently have a PE ratio of 62 times. And if we look at this table, we can identify some of the very popular popped bubbles in history. For example, the dot-com bubble right over here started at 1998, ended in 2000, and it rose 192%. It fell 73% when it popped. And the bubble popped because Federal Reserve actually rose interest rate in 1999 to 2000, triggering a correction and ended the bubble. And we can also see the Japanese bubble. We have the index Nikkei 225, and the start of the bubble was 1986, and the end of the bubble was 1989, and that's the beginning of the last decade. And during the bubble, the index was up 149%. When it's popped, it dropped 64%. And this is, again, the popping of the bubble is due to monetary policy tightening. Bank of Japan raised the official discount rate from 2.5% in 1987 to 6% in 1990. Bank of Japan also implemented credit restrictions, and of course the bubble popping also have to do with yen appreciation after the Plaza Accord, making it harder for Japan back then to export. And we also see the China bubble started 2005, popped in 2007. It was up 513% for the Shanghai Composite Index. It was dropped 73% when it's popped. And the popping of the bubble was because of the central bank tightening liquidity and raising rate in 2007 in China. And we also see the crypto bubble that was happening recently, starting in 2020 March, ended 2021 November. It was up 1,662%. It was down 78% when it's popped. And this was because of global liquidity tightening, as majority of the central banks in the world were tightening monetary policy to combat inflation caused by the pandemic. And today, this is the bubble we're dealing with. Again, Magnificent Seven restarted in 2023, March, and it's already up 186%. Again, the PE ratio right now is at 62. And this table also provides the average of the equity bubbles since 1900s. And on average, the bubbles goes up by 244%. The current Magnificent Seven bubble is up 186%, and of course it hasn't popped yet. Now the interesting question is it going to pop in 2025? What's going to happen? When is it going to pop? Michael Hartnett said in his report that a hawkish Federal Reserve could trigger the end of the current melt-up or the bubble, the Magnificent Seven bubble. He said that the money will rotate from stocks to bond in 2025 only once the Fed turns hawkish, which implies that if the Fed doesn't turn hawkish and continue to go with the slow easing cycle, the valuation of Magnificent Seven could continue to go higher or stay consistent with where we are. But if 2025, because of whatever reason, there's a turning point of the Fed going hawkish, it could be time to start rotating your money from the equity to bond. Thank you very much. Please don't forget to subscribe and like.